Fantastic. Friends, now we will understand a framework. This framework will be common for all the assets related accounting standards, whether it be accounting standard on inventories or fixed assets, that is property, plant and equipment, or investments or intangible assets. This methodology will be same, right? Listen carefully to what I am talking. There is an asset. What are all the things that the accounting standard is going to guide us on? First thing, to what categories will this accounting standard apply? To what categories this accounting standard will not apply? That is the first point what the standard will try clarifying. So applicability criteria we call it. Okay. So applicability criteria means to what categories this accounting standard applies, to what categories this doesn't apply. That is the first point. Second aspect, this standard will talk about something called as initial recognition criteria. What is the meaning of initial recognition criteria? From somewhere this asset will come into our books of account for the first time, right? Maybe this, say for example, car or camera or machinery. This is with some other manufacturer, some other vendor, and we bought it now. So for the first time it will come into our books of accounts, right? The first time when the asset comes into books of account, what all points should we remember from an accounting point of view? So what points we have to be careful about? So that is what we call as initial recognition criteria. Then after that there is something called as subsequent additions. What does it mean? We purchased a building. At that time, how to recognize that? That will be covered under initial recognition criteria. We purchased the building, used it for 2 years. Now we are incurring some expenditure on that building. We might be painting that building. We might be doing some repairs and renovation on that building. So in such case, how to deal with such subsequent expenditure on a capital asset? That is the next criteria what will be discussed. After that, we will learn about something called as subsequent measurement. What is the meaning of subsequent measurement? Remember friends, subsequent measurement is a phrase used with analyzing the value of an asset on balance sheet date. We purchased the asset on 1st April or 1st October, some date. But now we are at the end of the financial year. At the end of the financial year, at what value should this asset be shown in the balance sheet? That principle is discussed under subsequent measurement criteria. Excellent. Then towards the end you will have something called as derecognition criteria. What is the meaning of derecognition? Recognition is bringing that asset into our books. Derecognition, as the very word indicates, is removing this asset from our books. We sold the asset, we lost the asset, something happened. So then the asset should be derecognized, means from our books that asset should be removed. That is called as derecognition criteria. Friends, remember, in all the asset related accounting standards, this framework will remain same. So let's now talk about the applicability criteria for this accounting standard. So for whom is it applicable and for whom is it not applicable? Friends, it's important to understand for whom it is not applicable so that we'll understand to whom it is applicable. This accounting standard on intangible assets will not apply for financial assets. We will learn about financial assets in a separate accounting standard. It's one of the biggest standards we have, one of the most fascinating standards we have. We'll learn about financial assets later. Similarly, this doesn't apply to mining assets. So mining related assets, for that this accounting standard does not apply. Then this standard does not apply even to insurance policies. Similarly, discount on borrowings and issue expenses, share issue expenses we call them, public issue expenses or share issue expenses. For these, the accounting standard does not apply. Remember, whenever an accounting standard applicability or non-applicability criteria tells us that, hey, this accounting standard does not apply to these categories, mostly for those items there would have been another specific guidance given. For example, for financial assets, mines, insurance policies, etc., for insurance companies and all, there are separate norms on how accounting should be done. Even if you talk about share issue expenses, how it should be treated, what can it be used for, there is Companies Act which tells you how share issue expenses treatment should be given. So that is why these items are outside the purview of Accounting Standard 26. Great. Now let's come to initial recognition. Friends, if you pay attention, listen carefully to the logic of initial recognition. We can complete that aspect right now and you will remember this forever. Listen to the logic. Initial recognition means till now this item has not been seen. Till now this item was never recorded in our books of account. For the first time this item is getting recorded in our books of accounts. That is what you mean by initial recognition. For the first time this item or this asset is getting recognized in our books of account. Fantastic. When you are recording it for the first time, it means now you are passing a journal entry. Okay, you are passing a journal entry. When you have to pass a journal entry, let us quickly think about what all aspects will be there in a journal entry. There will be date, right? Then this account debited with this much amount, right? Then to this account with this much amount. Like this, there will be, just if you think of the elements in that particular journal entry, there is date, then there is account to which it is debited, value at which it is debited, then account which it is credited to, and the value at which it is credited. So these are the elements. Then you have an explanation, we call it narration, an explanation. So details of those journal entries, something like invoice number or whatever. So the details relating to the journal entry you will have in the form of an explanation below that journal entry. These are the different elements of a journal entry. You will realize if we go into each of these aspects and understand, in this scenario, how should date be affected, or when should you pass that entry, which account should be debited, at what value it should be debited, which account should be credited, at what value it should be credited. If you discuss this, that's it. You will be done with discussion regarding initial recognition. The date when initial recognition can be made will be determined on this principle. What is the principle? There are conditions to be met. First condition, confirm that the amount whatever is being incurred, it has the capability to generate future economic benefits. Capability to generate future economic benefits. Is this a part of meaning of asset or not? That's all. So it should be an asset. So it should have the capability to generate future economic benefits, and the amount should be measured reliably. Means you should be able to determine how much amount is that, because if you don't know how much amount it is, how will you pass a journal entry? Because for a journal entry you require amount, right? So if you don't know what amount of benefit or what is the value that you are incurring, then you cannot pass any journal entry. So that is why there are two conditions which we have to check. So as per the accounting standard, if we actually understand what the standard says, the first one, as per the accounting standard, these are the two aspects. An intangible asset shall be recognized if and only if it is probable that expected future economic benefits that are attributable to the asset will flow to the entity, and the cost of the asset can be measured reliably. Right. So we discussed about the date on which the intangible asset should be recognized. Let me add one more aspect to what is given in the accounting standard. You should recognize any asset when risk and reward in that asset flow to you. What does it mean? There is a car, there is a bike, there is a factory, whatever that asset be, tangible, intangible, whatever that asset be. When can that asset be recorded by you? When risk and reward in that asset get transferred to you. Meaning you should become the effective owner I am not even saying legal owner of that. For all practical purposes, you should become the owner of that. So that is when you can recognize that as an asset. Friends, listen, we are not worried about legal ownership. We are worried about effective ownership. What is the meaning of effective ownership? Substance over legal form, reality over legality. We should be the owner of that. Even though invoice is not generated by the seller, we actually took that asset away. That seller said, hey, my machine is not working, my computer is not working, I will generate invoice tomorrow and send it to you. But today you brought the asset away. So can you say that the asset is already yours? Well, if the asset is already taken away and if it is a norm that if you have taken it away, it is yours, then well, today itself the risk and reward is getting transferred, not tomorrow when the invoice is getting generated. So if you go with legality, you will ask, what is the date of invoice, what is the date of agreement, etc. Sometimes in business, in an informal manner, even without agreements, even without invoices, still transactions happen. So accounting always asks us to look at the reality of the transaction over the legality of the transaction. So the legal form is secondary, substance, real substance of the transaction is primary. So considering that, ask yourself, see, I'll tell you something. When you want to know whether the risk and reward is transferred, you know, this is not something that the accounting standard says, but I'll suggest something to you. Hand on heart, you will know whether really that asset is yours or not when you ask yourself, I took an asset, it is my friend's mobile shop, I took an asset, I took the mobile, and my friend said, hey, come on, pay me money after 1 week. Invoice also is not generated, invoice is generated later. I took the mobile. I know in my head, when I just come home, when I look at that mobile, do I feel that it is my mobile or do I feel it is a mobile of my friend's shop? What do I feel? If I feel, hey, it's my mobile, I bought it. Now, you know that, right? So that is what accounting asks you to think about, because sometimes, please understand, so many expressions cannot be put in words. So accounting standard will try giving a framework, transfer of risk and reward. But how do you know really whether risk and reward got transferred? Ask yourself this question. Do I really feel that the risk and reward is transferred to me? Do I really feel that this asset is mine? So based on that, you can actually start figuring out. Don't write this in exam. I just gave this example for you to understand how the transfer of risk and reward concept works.